The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as we take a look at midweek market action Wednesday, felt like another quiet-ish day in the grain markets. We slipped a bit lower in corn and Chicago wheat. Soybeans pretty much hovered around unchanged into the close. It was a better day in livestock futures with a decent amount of green on the screen in cattle and hogs. Let's talk about things and get some perspective from Mike Zuzolo with Global Commodity Analytics joining us here today on Market Talk. Mike, hope the week is going well so far, and I think for both of us, we got to maybe get a few good nights of sleep in ahead of USDA's reports coming up next week. It seems to be that's about the one big thing that a lot of folks keep talking about outside of a lack of a lot of other fresh news, Mike.
Yeah, we keep talking about it, but we don't trade it at all, and we're not trading weather. You know, it's very hard to explain why the wheat would take such a big drop to the downside, especially in light of Wednesday morning's news that the newly redesigned, if you will, Black Sea grain deal was going to be put back in place for 30 days. It was already on the rocks with fresh bombings and fresh missile strikes, Jesse. And it's really hard also to say that the wheat's going down because of improving weather, because the models had gotten a little wetter on Tuesday, but that wetness was pulled out of the models on Wednesday, and yet we find ourselves on new, essentially 3-week lows in the wheat complex, and we're down about 40 cents off last week's high. So to me, when I saw that President Trump was going to be talking about auto tariffs prematurely or earlier than the trade had expected, I looked at Wall Street, which had been running very strongly on Wednesday's trade. It went very quickly negative. And then I looked immediately at the dollar to see if the dollar would turn negative like it has when we get new tariff news. It actually did the opposite. We made new weekly highs in the dollar. And I think that's the bottom line issue with what this market's doing as far as the wheat back to pulling the corn down and really opening us up to some vulnerabilities technically.
Well, let's talk about the wheat markets to start. Let's take a look at a July SRW seasonal, and to your point, not necessarily trading weather issues or other things. And to your point, it was a bit perplexing as well for me to see the wheat trade go down on Wednesday. Walk us through this seasonal chart and what this chart tells folks, Mike.
Yeah, you know, I went back about 10 or 15 years and looked at similar price patterns and where we were in terms of actual prices and what matched up best about a month ago. And that's why the 2014 crop year is still on there. This is the July SRW. I'm estimating at this point, Jesse, that the funds are most short the most short the SRW, but the SRW has taken its cues from the HRW for the most part if we're going to have a drought. So the hard red would lead the soft red up. Funds would then theoretically short cover in the soft red. And that's why I'm tracking SRW. So 2025 July futures in red looks very similar to 2009 in terms of price performance and also where we're at in price specifically. It looks very similar to 2015. We've really gotten away from, ever since the end of February, we've gotten away from the 2014 market. And that's the one we need to get back towards or get back into a 2009 mindset. But I like doing this with the wheat because it's my leader, because it did create new weekly lows in the corn, and it did create some environments, technically speaking, where the corn is now very vulnerable. The key here is we're at the last week of March with the acreage, with the stocks, and also not just the tariff news, but also the beginning of the reporting in the first week of April of the weekly crop conditions again for the wheat market. So what we see in the wheat, and this is where it goes back to the Black Sea grain deal, we're going lower now since mid-March. The trade's not as worried about weather. They're more worried about demand. And when we heard the Black Sea grain deal was going to be instituted again for 30 days, the first thing I thought was, is it really going to hold? And second, even if it does Russia and does Ukraine really have any excess supplies right now? And what I mean by that is that just today, new quotes came out of Odessa for Ukrainian wheat and corn. They're both at 3-year highs right now. So I just don't see the practicality of this grain deal making any difference whatsoever in our actual supply demand fundamentals. And in fact, the biggest negative in this market, I think, for the wheat especially, and I'm getting this more from Chicago, is this extra cost put on shipping vessels from China. And a lot of people are talking about that right now and how that could hurt our wheat demand.
And that's a great point. Just another headline in the puzzle that we do need to think about is what could happen with some of those ship fees and more. Let's talk about the July SRW daily value levels. And I know this kind of goes with the last chart we just looked at. And obviously, when I look at this, seeing some pretty clear patterns here, some wedge formations, etc. What are you tracking?
Yeah, and I think that's number one. Number two is notice how we're heading back towards the low. That low was that March 4th low when the introduction of the big tariffs were going to be put out and were thrown out there. And the whole market got sick and just essentially vomited up its dinner. And we came roaring back the next week or two. And that's what led me to think that, okay, the wheat market can, with weather, continue to go higher and drag the corn higher into the end of March, giving me the opportunity to hedge both corn and wheat for new crop futures and new crop production for the clients and subscribers I work with. But we really got shot down last week, and that's when we had those negative export sales, and that's when the new tariff news and the shipping vessel issues started to really open up. And notice how I said a minute ago, we're now essentially 40 cents off of last week's highs, and we're right back up against going back down towards that March 4th low. And so are we setting up a double bottom in this market, or are we going to have to probe below that? So technically speaking, if the wheat doesn't come back and lead the corn back by Friday's close, the paper positions I'm going to have to jump into for the short term on the short side.
Well, let's talk more about the corn market. And to your point, wheat leading corn down on the day, Wednesday. And of course, everyone seems to be talking about what that corn acreage number could be next week. I mean, I hear it everything from 94 and a half to 95, 96 million acres. So I have to think that that's got to be at play here at some point in this corn trade, Mike. But what are you tracking on the weekly chart right now?
Yeah, to talk about that point specifically before we talk about the chart, Jesse, I think you're right in that the acreage number is going to be your DEES futures. Your stocks number is going to be your July futures. And one of the things that the clients and the subscribers are going to see along with our video, because they're paid subscribers, is a July DEES and a July NOVE chart on the old crop, new crop corn and beans. And we went down through a key support level in the July DEES corn chart on Wednesday. We're setting up the idea that we're going back to a carrying charge market. We don't need the extra premium in the front end futures because we've got plenty of supply to meet demand. Put the premium in the back end for the new crop so that the farmer knows to sell it, or to store it. But that is before the report. So this could all change and flip. If we come out with a tight stocks number and a big acreage number, I could see very easily why that July DEES corn spread would be a buy the July, sell the DEES type mindset. So very important this next 5 trading days to separate the flat price from the spread trade, because that old crop report in the stocks, new crop report in the acreage. And going back to these technicals, you see the wedge again in the corn just perfectly breaking, unfortunately, to the downside, hitting a key support level around 450. We took out last week's low of 455 and a quarter on Wednesday. That is a big red flag for me. So 450 is a must hold now going into the end of the week. If we don't do that, you really don't have a lot of support until you go back to the lows from 4 weeks ago. And if you go back to that, you're taking out your 52-week moving average. And then you're getting, I always feel like gaps are kind of like the saying, the world abhors a vacuum, politics abhors a vacuum. That gap back from the later part of 2024 where the blue arrow is, that really is disturbing me if we go back all the way down to those lows from 4 weeks ago.
We are talking today with Mike Zuzolo from Global Commodity Analytics here for our analysis on Market Talk. Let's Talk about the soy corn ratio a bit, and I think this will weave in more of the acreage discussion and talking new crop here. No 25 beans, D's 25 corn. This is something, Mike, you and I have been tracking this for several weeks now. What are your thoughts on what we're seeing right now with the ratio and what this could look like here as we go over the next several weeks?
Yeah, I think this ratio is telling us two things. One, it is expecting a bigger acreage number. And two, it could be a low in this spread or in this ratio, technically speaking, because a downtrending channel in white has now been violated. That's going to be important on Friday's close to see if we hold above it. And I say that because the weather patterns, again, look very dry or mostly dry in the Western Corn Belt, hard red wheat belt, spring wheat belt. West of the Mississippi River, it looks like we could pick up extra corn acres and probably at the expense of beans and spring wheat as well, and maybe tear up some hard red wheat if we get hot and dry in April in Oklahoma and Kansas. But the average trade guess, 94.4 million on corn. This is Bloomberg, 83.8 on soybeans. I like that average number for the report. I'm 94 and 84 right now, but I could see why we'd swap out 400,000 to 500,000 acres in favor of the corn. I think the reason this market is going after buying beans and selling corn, especially now at this point later in the week or in the second half of this week, is because they feel more secure that the corn demand in that July D's corn spread is not going to bite them in the butt, so to speak. We also have a top end corn range of a 96.6, and I think that might, because of the way the funds trade these estimates by the news wires, we might have had to price that in as well.
It's very interesting just thinking about this market as a whole here and these ratios, and just to kind of hammer home the point that one, who knows what we're going to get for a number from USDA that'll set the new goalpost. But then two, someone reminded me of this the other day, that Mother Nature ultimately is going to hold the cards here for these markets, and these acreage estimates could be changed widely by the time we get to June, July, September, et cetera, Mike.
Yeah, I think that's a great point. And because to me, Jesse, the acreage number is all fine, but it's really the stocks number that has the lasting impact on the trade as far as the price trend. Because you're 100% right. 30 days from now, the acres won't matter unless we're in a 2009 type situation and too wet to plant corn. And that, though, goes right back to the yield, the national yield. That's really what's going to count the day after we get the report. And this year, with the tariff news and the uncertainty about the tariffs, I think the acreage means even less. I would actually go back to the idea that South America maybe matters more than the acreage number for us here if we don't have weather problems. And I say that because, like the Ukrainian corn price, there are areas in Brazil that have not been able to get harvested. They're 10 to 15 points behind last year at this time, and farmers are not selling, and their prices are at 3-year highs right now. And my South American colleague alerted me to that a couple days ago, and I did some investigation, and sure enough, there's some real problems in some areas that are really pushing corn prices high. Ethanol is part of this. Meat is part of this. But it really is also the weather side of the equation. So I still think the weather and South American corn production is easily as important as the U.S. acreage number. I really think stocks are where I'm going to put I'm going to really rely upon the idea that we can, or we will or we won't get hurt too much by tariffs. If we come in with a really low stocks number in corn, in other words, and a really low stocks number in beans, in other words, that tighter supply could insulate us from the tariff effects.
All right. I want to switch gears. You mentioned meat. You mentioned ethanol energies. I want to talk about those things before we close out the show today. Let's take a look at boxed beef. And man, Mike, this boxed beef market has been something to watch the last several days. I think it was Tuesday, we were up over $8 in choice cuts. I mean, what are you watching here and how this is playing into the cattle market right now?
Yeah, the first thing you see on this chart is the outside, week that we're seeing in the fat cattle, and that's a really nice thing to see. Let's hope we stay above last week's close and last week's high, especially. And that would be because of the box beef, because of that 335 level in choice boxes. We're now approaching the 2021 high. And right behind that is the 2020 high, upwards of 370. And so this is where we're in record territory with box beef. And so I'm looking for reasons why we can come back in the cattle market when the bullish cattle on feed placements number from last Friday did not override the fund selling. That was important because I'd slapped some hedges in place for Q2 before the report came out. I saw those placements numbers. I thought, oh, I might have to get out of these because we might be able to go back up and revisit the old highs. Well, it really is not looking that solid as far as upside potential unless we get the box beef really turned up the volume like 2020 and 2021. That keeps your fat cattle price at 212, maybe even 215, and gives us a real chance to go back up in the futures. But right now, it's really a battle between the fund selling and what we're seeing in the cash market, and somebody's going to have to give here. I'm still on track, Jesse, for the high or a major high to be in place, and most likelihood and seasonally and historically by the time April fats and April feeders go off the board. So that's kind of how I'm playing it right now still.
I asked someone this as well the other day, and I'll throw this to you. I wonder if this cattle market, we've been watching these highs and more and all this activity in the cash trade for some time. Are we setting a new normal price range though in cattle, or is it just a matter of when the other shoe drops, Mike?
Yeah, I don't think so. I think it's an excellent question. I've asked myself that question often, but I don't think so. I think we got to go back to part of the reason why we've been able to charge this market up so high has been the egg prices, the egg tight supply, the protein tightness of supply. The cattle and the beef and the funds have really picked up on that. And so if I put together the egg price high being in because imports are coming in and prices are coming down, and then I throw on top of that China's weakness in their economy and their weak pork market, and then I throw on top of that the fact that Japan is going to Brazil to inspect packing plants in Brazil so that they can buy more Brazilian beef because they know we don't have any. And then I throw on top of that, Australia has been preparing for the last 6 years to sell us excess beef because they knew we were going to have this cattle cycle high and low in production. In other words, I guess, no, I don't see it that way, Jesse. I think we're really kind of rubbing up against the forces of rationing demand more than we are running up against the forces of record low supplies and new highs and new ranges that are higher than the old past ranges.
All right. I do want to ask you energies. We got one more chart to take a look at. Looking at crude, WTI versus RBOB unleaded. I know we got some updated weekly numbers on the ethanol side and more on Wednesday. What are some things you're tracking in the energy market right now, Mike?
Yeah, not great ethanol numbers at all. Lower production, higher stocks. But what I've noticed here and what I wanted to share with you is in the blue line, the RBOB unleaded futures, we are moving to new 2025 highs. Crude oil is attracted to that, and I think that's part of the reason why the crude oil market is going higher other than geopolitical premium. But this goes back to a red flag as we get into summer grilling season. Every year, the RBOB becomes one of my top 5 factors because are you going to buy gas? Are you going to buy meat? Are you going to go out? Or are you going to go drive? And that's kind of where we're at, especially with that consumer confidence number coming out at a 4-year low earlier this week. We also had Smithfield Foods come out with their updated quarterly earnings. Year over year for the fiscal year 24 versus 23, their volume of slaughter for their fresh pork or volume of sales in their fresh pork down almost 5%. So we're seeing the demand rationing take hold. Gasoline prices at the pump are going to be very important because I'm already nervous about this year's summer grilling season.
Final thoughts, Mike. A lot of stuff we've run through today, and I know there's going to be a lot of data, news headlines, and more coming at these markets in the next week to 10 days. What would you leave folks with here today?
Big picture, technicals are opening up to the downside if the bear gets fed, and we just had some recent highs that I think are excellent areas you can stop yourself out at. So as opposed to putting your head in the sand right now and not doing anything and waiting until you plant, I think it might be a good idea to look at the paper side of the equation for covering yourself for the downside and using maybe stops from last week's highs or this week's highs to pull yourself back out and let the reversal happen if you think there's going to be one.
Mike, if folks want to reach out for a conversation, take a look at your great analysis and more, how could they do that?
Yeah, and I'm extending my trial. It won't say it on the website, but I'm going to go 3 weeks because of the circumstances and the volatility in this market. Go to globalcomresearch.com. That's globalcom with 2 M's, research.com, and sign up there.
Always appreciate it. Mike Zuzolo, Global Commodity Analytics. We'll talk to you next week, my friend. Thanks for joining us.
Thank you, Jesse. Appreciate you having me.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.